Oil is down another 5% and US stocks are up over 1% on hopes a Middle East ceasefire will hold. US consumer confidence drops. US Fed Chair Powell reiterates patience on rates. And Australia's consumers get a boost from year-end sales. That's coming up in our 5 Things in 5 Minutes on Wednesday, June the 25th. And then in our deep dive interview, ANZ Group Chief Economist Richard Yetsenga explains why his latest research quarterly note has the tagline "Shaken but not a shambles."
I still don't think there's a meaningful risk or in fact an escalated risk of a serious global downturn. The world is slowing, but it looks very mid-cycle to me.
But first in 5 and 5 with ANZ, I'm Alex Tarrant in for Bernard Hickey. Oil is down another 5% and US stocks rose as markets rallied on news of a ceasefire in the Israel-Iran conflict. In the US, Fed Chair Jerome Powell, in testimony to Congress, reiterated patience on rate cuts. He did say, though, that low inflation could allow for a move sooner rather than later. That came as US consumer confidence unexpectedly fell in June. Here's ANZ economist Bansi Madhavani.
The survey showed that there are lingering concerns about the state of the economy, business outlook, and job market as a result of tariffs. Consumers are more pessimistic about business conditions. They are downbeat about job market prospects and what that means for their income outlook. The decline in confidence was a broadly based one. Assessments of both present situation and expectations for future both deteriorated. The data are showing that growth momentum in second quarter is fragile.
At 4 a.m. Sydney-Melbourne time, the S&P 500 was trading up 1.2%. The 10-year US Treasury yield was down 2.3 basis points at 4.296%. Gold was down 1.83% at $3,332 US dollars an ounce, while West Texas Intermediate futures were trading down a further 5.5% at 64.75 US dollars a barrel. The US dollar index was down over 0.5%. The Aussie dollar was up 0.76% at 65.07 US cents, while the Kiwi was up 0.75% at 60.21 US cents. Number 2. The US dollar's move lower yesterday came as the oil price and risk sentiment eased. ANZ head of FX research, Marjabeen Zaman, expects the dollar to maintain its downward trend.
This is really on the back of fading U.S. exceptionalism from rising growth concerns. We expect the Fed to ease 2 times this year and once next year, so 3 more rate cuts will weigh on the dollar. Of course, the U.S. is facing growing fiscal deficits, and we are also seeing a lot of global pension funds possibly increasing their hedges against shift in the dollar. And so that would overall weigh on the dollar as well and support its downside.
Number 3. ANZ Roy Morgan Australian consumer confidence rose 1.3 points last week to 86.7. ANZ economist Sophia Angala says the rise was led by the time to buy a major item sub-index amid sales events. It wasn't all one way though.
Confidence in the economic outlook weakened despite the labour market data last week suggesting that the labour market appears to be tracking better than what the RBA had expected in its May statement on monetary policy. We also saw the weekly inflation expectation series fell, and that's a reversal of the rise that we saw last week. Weekly data can be bumpy, so we will be watching to see if geopolitical uncertainty impacts the weekly inflation expectation series just through consumers' expectation of oil and petrol prices.
Number 4. Australia's monthly CPI indicator is expected to have fallen slightly to 2.3% annually in May, due in part to lower petrol prices over that month. ANZ Group Chief Economist Richard Yetsenga says the overall picture, though, is one where disinflation has stalled.
There is a broad range of indicators which suggest even though growth has not picked up the way many people thought, the improvement on the inflation side has definitely slowed down. For this month, we expect to see a pretty well-behaved headline CPI number, 2.3 versus the market of 2.4. The broad message there is still within the band, but I think to the extent the bank thinks about probabilities, the risk of an inflation undershoot has diminished.
Number 5. Malaysia's CPI came in at 1.2% annually versus the 1.4% expected in May. Meanwhile, recent data showed exports down 1.1% in the month from a year ago, compared to expectations for a 7.5% increase. ANZ economist Arundam Chakraborty says that led to the lowest trade surplus outside of COVID since 1997.
It was mainly driven by a weakness in electronics products exports, while non-electronics exports have remained persistently weak over the last 9 months. Country-wise export data showed that exports to the US remained strong at 32%, reflecting ongoing front-loading activity. This was more than offset by declining exports to other major export partners like China, Japan, and South Korea.
Arundam Chakraborty there. Now, in our deep dive interview, I spoke to ANZ Group Chief Economist Richard Yetsenga about his latest research quarterly note on the world economy, titled Shaken but Not a Shambles.
It's so easy to look at the world and, I guess, in a virtual sense, throw your hands up in the air, and definitely kind of, military conflict and tariffs, geopolitics, pressure on prices. There's lots to kind of worry about. But I think when we disentangle those, they're more important certainly for individual economies or asset markets than they are about the world as a whole. I still don't think there's a meaningful risk or, in fact, an escalated risk of a serious global downturn. The world is slowing, but it looks very mid-cycle to me.
You say you're still not forecasting a recession for the US. Is that the same across those G3 economies?
Yeah, we're a long way from recession everywhere. In fact, we have the Bank of Japan still raising interest rates over the next 12 months or so. And in fact, very few central banks cutting rates in 2026. Almost all of the easing cycles are likely to be done this calendar year. New Zealand is an obvious example, but also really in terms of meaningfully sized economies, it's the US and Australia which have a little bit more to do in 2026.
In China, obviously, we've been looking to see what the impact of those tariffs are. Your chapter is called Collapse Avoided. But what's the outlook now, I guess, as we get through this sort of tariff turmoil and into the back half of the year?
Well, let's think back to about the 7th of April. Collapse avoided actually, I think, is a relatively good outcome relative to that. And I know nobody thinks of the world that way, but I think we should keep referring to those stress points because we have actually seen a world which has shown some resilience and a policy process in the US, obviously, which has tended to step back from the most extreme positions. China has structural challenges. We're not shying away from that. The economy is not at risk, in our view, of a serious problem, but growth is likely to be slower over time. And this year, a low 4 point something is our expectation. And the primary influence on that is the US.
What's the outlook for Australia, particularly given that outlook for China?
It wasn't that long ago there were voices in Australia effectively questioning the sanity of the central bank. Well, can't they see the pricing pressure? Those voices at long last have gone and people agree rates are coming down, so we can argue about the pace, and in our view it's pretty slow and pretty modest. Others will have a slightly more accelerated view. I'm not going to die in a ditch about the differences there. I think rates coming down a bit is okay. This is also an economy where the disinflation process seems to have stopped. Over 2023, particularly into 2024, the inflation indicators came down quite a long way to be consistent with inflation in the target band. And then for much of the last 12 months, that improvement has ended and we've really had these indicators tracking sideways. This is what a low productivity growth economy looks like. You look at the activity side and you'd like it to be stronger, but you look at the prices side and it's not giving you a lot of room to bring rates down.
Continuing a look down under with New Zealand, potentially more easing in terms of what the RBNZ might be looking at.
We've got 3 more rate cuts for the RBNZ, and then we've penciled in a couple of hikes to the end of the forecast process just to signal the interest rate cycle is turning. New Zealand is early, and the economy does look like it's responding to the rate cuts, but it's also been early in a world which is still slowing today. So that, I think, is going to give you some reasonable cross currents into the New Zealand story as this domestic turn and domestic momentum kind of meets global momentum coming the other way. I think that suggests what we've seen in the last couple of months, where just a bit more tension and differences of view about what the RBNZ is likely to see and likely to do. I think that's going to persist for about the next year.
Then Asia ex China and India, what's the outlook there?
Look, certainly they look relatively good relative to the US, but the regional economy is going to have a challenge over the next 3 to 6 months with the give back of some of that bring forward of trade. The numbers have surprised a lot of us with the strength of regional trade, and partly that's been the fact this has turned into a US slowdown rather than really a global problem. That means the trade diversification that we have seen can probably persist, whereas if you asked me on the 7th of April, I would have been worried about even that. But you have had this bring forward to beat tariffs. Asia's going to have to give some payback on that over the course of the third quarter. I think that's going to make Asia probably look soggier than it really is, but that sogginess will be real.
Richard Yetsenga there. I'm Alex Tarrant, in for Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, June the 25th. Catch you tomorrow with what Australia's May inflation data could mean for the RBA.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.